Morning, everybody. It is July 24th, 2023, 9:21 a.m. It has been a long 2 days away from the precious, precious market. And now we're back, and it's time to analyze what's going on in the markets. Joseph, Ray, Bexino, Canman, Johnny, the Legend of C, iBot, Star Buccaneers, Arrow, Fernando, Miyoko, Big Billy, Edwin, wake up. I am up and I am ready to go. Damian, Drew, Cameron, thank you all for being here. Mark LeBlanc, Pangao Tan, Dex, Mr. Room, The Victory Meta, Gregory, Astericus, Jared, Stefan, Phil, Felicia, Mark, Iraz, The Victory Meta. All right, it's time to begin. Oh, wow. We got Sachin and Kelly here. Hey, hello, guys. Thank you for being here. So, what do we got going on today? We've got some really interesting stuff going on that I want to talk about. I've been up since about 7 a.m. reading a bit of the Wall Street Journal, trying to wrap my head around one of the core things that I'm trying to understand, and I would love for anyone in the chat to also help me with this. Thank you all for being here. Inflation data. What's going on with inflation? So obviously, what's the big news this week? This week on Wednesday, the Fed is going to announce a 25 basis points rate hike. Banks have basically estimated there is a 99.08% chance that it's happening. So there's a couple of banks that are like, it's not going to happen, but the far majority of banks are like, this is going to happen. And most of the banks, from what I read this morning, say it's going to happen and then there's going to be the pause. Now, the Fed cannot say that it's going to happen and then there's going to be a pause because the Fed needs to keep optionality in place. If they get rid of optionality, the market's going to go euphoric. The potential reacceleration in inflation that we're having, that I'm about to get into, might get worse if the Fed takes the second rate hike off the table. So more likely than not, we're going to get a hawkish Fed. There's going to be a bits of dovishness there because the CPI PPI report we got last week was phenomenal. It's what the Fed wanted to see, but we're going to get a rate hike because the Fed does not want to take their foot off the ball. Some could argue there's no reason we should have a rate hike, but more likely than not, there's going to be at least one hike with the option of two. But that's where I think we're going to have actually some momentum, and the market has already priced this in. Whereas the second rate hike most likely is not going to happen. Now, if that is the case, the question then becomes, are we in a place where inflation is decreasing well enough for us to not have to worry about this massive kind of recession that some people think is looming and that most people on Wall Street think is going to be a soft landing? So here's Truflation's data. This is some of the most accurate data we have on inflation. It's up 2.4% and it was down at 2.13 just a couple of days ago. What are we seeing the reacceleration in? Food and beverages is up. So you see this little tick right here from June. It was down at -8%. Now it's at 4.28%. And this is a specific subset of them. Overall, all of it is down about 1 or 2%. This has a relative importance of about 15.3% on inflation data. So 15% of inflation is food and beverage, and that is ticked up, as you can see, from June all the way to July. You have food and non-alcoholic beverages, food at home, and then food away from home. Housing is also up just a little bit. So people are getting more exciting to buy houses. It was at 2.9. Now it's at 3.06. This is about 23% of relative importance when it comes to inflation data. Why does this matter? Because if we are not seeing sort of this deflationary effect in housing, in terms of there's more demand coming in and there's not enough supply to showcase for that demand, houses are going to go up, right? And we're going to see some acceleration in inflation when it comes to housing. And so these numbers are tiny, but they're enough where you want to think, okay, what's going on here? Transportation is coming up just a little bit. Obviously, gasoline, energy, that has gone up. Brent futures are still up for the past 4 weeks. They've been up. And some of the stuff going on with commodities in wheat, and Ukraine being a big exporter of wheat and how Russia's kind of not allowed them to export as much, that is also showing a little bit more inflation in commodities, which is having an effect on oil as well. So in general, we're seeing some inflation. If we go to Wall Street Journal, the main headline today was why the Fed isn't ready to declare victory on inflation. And the core thesis of the article was simply that although we're seeing a deacceleration in inflation, a decline in inflation, the reacceleration of certain parts of it are coming back. And until we know if that's just a fluke, and what's the argument for that being a fluke? Well, the argument is we had such a dramatic pull down that you're going to get a little bit of, it's like if you lose weight, it's like if you lose 20 pounds in a month, it's not sustainable, right? You're going to gain probably 5 or 6 of those pounds and then over the long term continue to lose that weight. And so that's likely what we're seeing here. But the question is that what's happening, or is this a broader trend? I default to the former, that it's likely, a little bounce and then we'll likely be back on the trajectory of going down further from there. Morning from Denver, Colorado. Robert, thank you for being here. Sachin says the Fed will do 2 hikes, not because it is needed, but because they have said it, and it will happen in the next 3 meetings as data suggesting inflation is tamed, but they've said they will do, so they will do it fast. Yeah, that is very possible. From all the analysts that I've been kind of reading and listening to, their argument is it's one and done, and the second one is just, the thing that's in the air. But honestly, the Fed, they say you can't fight the Fed, and it's more likely than not that the Fed is just like, you know what, we said we were going to do it, we're going to do it, and then we're going to leave it as it is. Now, here's the thing. 1 or 2 hikes relatively doesn't matter in the grand scheme of things. You go from 5.25 to 5.75. It really doesn't matter. What matters is how long is the Fed going to leave interest rates the way they are? Because you can have 1, 2, even 3 more hikes. It is what it is, right? Let's get to 6%. Boom, let's have a party. But how long is that going to stay? Because if it stays for a month, markets are going to perceive it as, all right, we're coming back down and things are going good. If it stays for the next year at 5.5%, then the whole soft landing we're anticipating, or at least from a market perspective, appreciation in equities, is likely not going to be as strong as we think it's going to be. You look thinner, Amit. Good. Okay. So that cardio I do every morning is actually working out. Those 5 miles every morning is showing a little bit of effect. We got a lot of weight to lose by the end of August. I have a specific target I want to get to. So hopefully we get there. Watching live from Greece. Thank you, Sasky Rose, for being here. All right, so let's get into some of the charts and see what we're dealing with in terms of equities. Personally, how do I think things are playing out? I think it's a little bit too early to tell, to be honest. Netflix and Tesla didn't shit the bed, but they ran up way too much going into earnings. So the market has, obviously took them down. Tesla now at 256 in the pre-markets. It was at 292, right? So like 256, 292, 256 is not that crazy to me, because of how quickly it ran. I think 256 is still, it's $824 billion for Tesla. It's not that bad. The problem is everyone who was buying it at 260, 270, 280, 290, thinking this thing was going to go to 330, that made no sense to me at all. So, at 255, do I think it's a buy the dip opportunity? No, because I think we need more clarity on what is going on with the Fed. But it's not like this is, oh my God, the world is falling down because Tesla's down $40. It's like, well, Tesla ran up like crazy before earnings. Now, big tech is going to determine a lot of what's going on. Microsoft, Google. Microsoft now at 345 in the pre-markets. Google at 121. There's a good chart I'm going to pull up as well that actually shows what the expectations are for earnings. And the expectations for earnings actually is all these companies coming in at around 8 to 10% growth. Meta's expected to grow 8%. Google's expected to grow 10%. Microsoft's expected to grow like 7 or 8%. If they can match that, then we might not be in the worst place in the world. Netflix now at 427, Tesla at 260, Meta, where's Meta at? Meta's at 295, so Meta down from 316. If big tech does not crap the bed this week, we have a much likelier chance of surviving Q2 without a massive rundown in the S&P. I am of the belief that the S&P 500, although it is up, because of 7 companies, and although it's done really well, it does not have the momentum to sustain itself unless big tech is able to prove that they can justify some of the valuations that they have gotten. And if they can't justify the valuations they've gotten, we're in for some downturn. And so this is why this is one of the most critical weeks. Not only do we have the Fed FOMC meeting where we're likely going to get a rate hike, and it's priced in. That one rate hike is priced in. We'll see how the market interprets what the Fed says about the second rate hike. But big tech earnings, if they do not pull up the way they need to pull up, it's going to be an interesting week for the markets. In the grand scheme of things, I think inflation is heading down, and I think we're in the right spot. But any shift to that macro thesis, which can shift based on new data, puts us in a new spot for where we think the market's going to end up. All right. In 2 seconds, the stock market will be open. It is now open on July 24th, 2023. Wake your ass up. The stock market is now open. Here we go. We've got Netflix at 425, Tesla 256.11, TFC goes to $33.11, is up 0.21%. Palantir at $16.62 up 1.112%. Meta at 296, up 0.77%. Apple at 193. Apple has ordered its suppliers to bring out a they ordered 85 million iPhones for the iPhone 15. So they told their suppliers, hey, get ready to make 85 million iPhones, which is exactly or relatively the same amount that they ordered last year. So the market's probably interpreting that as not that much growth for the iPhone, but still 85 million is not bad. Nvidia 448 up 1.12%. SoFi 9.45 up 0.32%. Carvana, 46.15, up 1.16%. SLG down at 1%. TSM, guidance wasn't amazing. They said things are not going to be the best in the next couple quarters. 97.3, up 0.07%. We've got DNA, Ginkgo Bioworks, up 0.21%. Robinhood at $12.84. It's up 0.63 cents for the day. Unity, $45, 1.15%. This is down from $50 last week. Let's go into some of the financials. JP Morgan, what do we got on JP Morgan? 155. JP Morgan continuing to show record profits and doing just a phenomenal job. So it makes sense why JP Morgan is continuing to do and the market's giving it a little bit more of a premium. Let's check out Bank of America. Bank of America at $32.14, up 0.5%. Wells Fargo is at $46.18, up 0.48%. Enphase earnings is this week as well. Enphase is going to be really interesting because either they're going to show Q3 guidance is good or they're going to show Q3 guidance is bad. And that is going to determine pretty much everything that happens when it comes to Enphase this week. And if Q3 guidance is not good because interest rates are still high and, Enphase is like, hey, people aren't financing solar products because in order to get solar, you have to, take out 10, 15-year loans. Then Enphase is not going to do that well. So it's going to be really interesting. I'm hoping for an Enphase dip. I mean, if we get that sucker to 140, 150, that would be amazing. And hopefully 130 is where people are really looking for it at. But if it's already priced in and Q3 guidance is good, it could run to 200. It's just going to be a question of Q3 guidance. S&P is up 454. Let's check out the NASDAQ. Oh, by the way, the NASDAQ rebalancing, NASDAQ at 14,099. So we're above 14,000. We were at 14,446 on Friday. Is done. NASDAQ rebalancing is done. We are done with the NASDAQ rebalancing. For those that didn't know what the NASDAQ rebalancing was, it was essentially the NASDAQ's way of rebalancing certain things that they couldn't be overweight on. And Tesla wasn't part of that. Apple, Microsoft, Nvidia, all that rebalancing ended in the pre-markets this morning. So that sell-off that we saw, which is why we saw some decline in mega cap tech, actually came down, or actually is over, which means we shouldn't be seeing too much of a sell-off there anymore. Nvidia at $448. Nvidia earnings are going to be very interesting. I mean, they guided for 60% revenue growth. So if they continue to follow through on that mission, then Nvidia is going to do really well. Just a question to see if Nvidia is also going to be able to get there. Apple at 193, SoFi down a little bit at 942. Let's go back to Palantir. Where is Palantir at right now? Palantir at 1655. I'm actually surprised Palantir opened up positive this morning. I mean, I was so Q2 again. We're going to talk a lot about it over the next couple of weeks, but I'm cautiously optimistic for Q2. In my head, I'm like, it's not going to do well because numbers aren't going to be amazing for this quarter, and this valuation is still a little overstretched for Palantir right now to justify the growth. In my heart, I'm like, I think the demand is there, and they're going to show that the demand is there, and the market's going to interpret the demand, and it's going to be good. So ultimately, we're going to see what happens. Again, S&P now at 454. All right, not a bad open. We got some pretty green stocks opening up and getting into this market. What do we have here? I think they sandbag a lot. Enphase earnings have actually been really good. I think the big thing about Enphase is that outside of Q2 results, if their guidance is sandbagged and the market thinks their guidance is sandbagged, then yes, they're going to be fine. But in general, it really depends on where they think interest rates are going. And the hikes are not good for Enphase. I mean, particularly to finance solar, you need to have low interest rate. No one wants to pay 7% to finance solar for the next 20 years, especially when most people don't even believe in solar. So it's not the easiest way for markets to interpret it. Let's take a little bit of a look about inflation forcing inflation and what it's going to force the Fed to do a little bit more. This clip is actually pretty good, and it talks about where the Fed may need to be a little bit more aggressive when it comes to rate hikes this week. Again, FOMC is going to be the big thing this week.
Now, talk about the expectations for the Fed. Roger Ferguson, former Fed vice chairman and a CNBC contributor, somebody who I've said it before has gotten this right. And we're all trying to figure out. The big question is whether you think with this market melt up or whatever you think's happening, that actually makes it more likely that we get a rate hike, not a rate cut. My apologies.
Well, certainly the first rate hike is certainly baked in. I think there are a number of factors that might encourage that second rate hike. First, they've already mentioned that as a possibility. And secondly, as you point out, the economy is continuing to do very well, fortunately, giving them room for one more move if that's what the data call for.
And after that, what do you think? Where do you think this all goes?
Look, I think they are really what they say they are, which is data dependent. We were pretty pleased, but I think they were also pretty pleased with the last print from the CPI. But it's far from over that they're getting inflation definitely down to that 2% number. And I think part of the problem is inflation still might be stuck a little higher than 2%, forcing them maybe to do not one more after July, but possibly two, if that's what the data call for. So I think too early to say only one, certainly too early to say two. We'll wait and see.
I'm glad you said fortunately with the economy, because I would hate for the Fed, in light of those good inflation numbers, Roger, and you're right, we're not where we want to be, but they were certainly friendlier than people thought. I'd hate if the Fed just said, wow, we just aren't making any progress slowing this economy and raising unemployment. We should just do it just because we need to do it, because we're not orchestrating even a soft landing. Maybe we're not orchestrating anything at all. That would be a bad way to, but you tempered that with saying that they'll be data dependent. If inflation cooperates, you don't hike rates just because the economy is strong, do you?
No, you're absolutely right. Their job is to get inflation under control. They've said they're aiming at a 2% target, and they want to be very convinced that inflation is moving in that direction. Once that's established, the other part of their dual mandate, which is to create maximum sustainable employment. So I think they are at this stage balancing both, stronger focus on inflation. But once inflation is under control, I think they would be relieved to be able to say, job done. Not there yet, however. Not there yet.
Do you have any different view of where you?
Now, so here's the thing, right? And this is the biggest thing that's going on right now. He is similar to very many other analysts that basically think the Fed is not trying to fight with the market. The Fed is simply trying to get to a point where they don't have a moment in 2021 where they said inflation was transitory. And in order to make sure that they say inflation is not transitory, or have a moment like that, they need to actually be over, you would call it cautious, I guess, overly protective versus under their expectations. When they said inflation is transitory and we got 10% inflation, it destroyed all legitimacy in the Fed. And so we're seeing a lot of green this morning because it seems like the market is factoring in that things are going okay. But the question becomes, on that Wednesday meeting, what is the Fed going to say? Are they going to be excited about potentially inflation coming down? I mean, you would imagine Jay Powell is going to be at least somewhat happy that CPI came in the way it came. Even core inflation reduced 0.2% month over month. So people are like, oh, CPI's headline, it doesn't matter. Well, core decreased as well, which is why we saw the run-ups that we saw last week. Or are they going to continuously kind of stay stringent on this idea that the market has to get back to normal? Remember, inflation's at 3. The Fed's target is at 2. Getting from 3 to 2 is going to be a hell of a challenge. And we're seeing a little bit of momentum in terms of us not being able to get to that 2 level, definitely not in the next couple months. But if we can end the year at like 2.6, 2.5, it could hopefully lead to 2024 having a pause for a while and then actually seeing cuts. Right now, there are some people factoring in the fact that cuts are not going to happen for like the next 2 years, which that's not crazy unreasonable to assume. But if inflation is starting to fall more precipitously, then yes, we're going to definitely get cuts in 2024, maybe even by December 2023. But that really depends on what happens over the next couple months. The next thing that really matters here is the job market. TFC, we're seeing up 0.76% cents today. TFC or the job market is incredibly important because of the job market, which we've seen a really decent job market. Actually, the job market has not been bad at all. If that continues to go the way it's going, then there's also an argument to say that we don't have this looming recession that we think is going to happen. Now, here's someone who's a little bit more bearish and thinks that this is someone who's called the S&P to like 3,200. Let's hear his thoughts on where he thinks the markets are going in the context of a recession.
Jason Trennert, he's the chairman and CEO of Strategas Research Partners, which is a Baird company. And Jason, I know you've been thinking about the Fed. Everybody has. Expected to hike this week, and then what? And you're of the opinion that they're going to be pretty hawkish with the commentary.
I think so, and I think certainly given the data lately, because they clearly want to slow the economy down. There's clearly, I would say, some employment pressures. You thought unemployment claims were rising; they're actually now started to fall again, and the Fed's very concerned about labor. So I think Fed's going to tighten tomorrow and then talk pretty hawkishly about the September meeting. Now, this is the biggest pause of the year, if you will. This is the biggest stretch of time between Fed meetings.
Yeah.
And so there's probably an extra incentive to talk a little bit hawkishly, I think. But I'm not sure it might
And again, that extra incentive is rooted in optionality. The Fed needs to make sure they have options for the next meeting to be able to do whatever they need to do.
Might matter much for the markets given the way they've been trading, but
you brought up something that I hadn't really thought in this context. Do you think the Fed's going to be watching all of this labor strife and the potential strikes as another issue because higher wages leads into inflation down the road?
I don't think a small percentage of the U.S. workforce right now is unionized, at least among the private sector. There's more public sector union members now than private sector union members. So, but in the 70s, 30% of the workforce was unionized, and that's how you got a wage price spiral. Here, it's a little bit different. It's different now, but by the same token, they set the stage, at least from a news cycle point of view, or at least just framing for everyone else that's out there. And if you looked at United Airlines, you look at some of the airline pilots, they've gotten very rich already, very 40%. Rich. I'm not saying they don't deserve them, but 40% over 4 years is meaningful. Then you have the Teamsters, UAW, and Hollywood. And to me, they're going to be watching those negotiations very carefully, because if those get set as high as the airline pilots are, it seems to me they have more work to do.
You've been waiting for this recession that the bond market's been signaling for forever at this point, waiting for the markets to kind of fall into that slump. And
all right, so here he's going to give his justification for the recession.
At the same time, we've seen this crazy melt up.
Yeah.
How do you make sense of that?
Well, listen, I think, first of all, the economy is more resilient than we had expected. So, so you could say, we're early, but that's like a euphemism for wrong. So the economy is clearly more resilient than we thought. Also, though, I would say if you look at the stock market this year, if you look at the S&P 500, during the week of Silicon Valley, the S&P was up 0. It was up 58 basis points in early March for the year to date. As soon as Silicon Valley Bank failed, the market took off, and that was largely because the Fed stopped quantitative tightening,
This is a good point.
A lot of money into the system, and then you also had the Treasury that was injecting a lot of liquidity because of the budget ceiling, debt ceiling. So listen, that's how I make some sense of it.
But if the facts change, have you changed your opinion of what happens next to stocks?
It seems to me, though, given the valuations of the market, let's say I'm less bearish. By the same token, I don't know if I'd be putting a lot of extra money to work here, because the market's trading largely at pretty close to 20 times expectations of next year's earnings, which are pretty, at this point, still pretty optimistic. There's absolutely no, it seems to me, very little chance of a recession in where the market is trading today. The very little recession is actually priced into the market today, and that makes me worried. The risk reward seems to be upside down. You're risking probably $2 or $3 for every dollar you might make in the S&P 500, and generally you want that to be the opposite. You want to make $3 for every dollar that you're risking.
What are you looking for in earnings this week?
Listen,
okay, so I want to continue that, but for a second, what his argument is actually not that crazy. He's basically saying before Silicon Valley Bank collapsed, the S&P had done nothing. Then in March, the S&P or Silicon Valley collapsed, and the Fed injected $400 billion of liquidity to basically save the banks. Backstop FDIC insurance went from $250,000 to $2 million, right? So Roku, that had I think $400 million in Silicon Valley Bank, that was given back to them by the Fed, right? Because the entire bank collapsed. Now, the one thing he's not talking about that's really interesting to remember is that is also when ChatGPT reached 100 million users. That is also when the market started realizing the potential of AI. That is also when NVIDIA gave 60% revenue guidance growth quarter over quarter. That is also when we started seeing a lot of these sort of arguments around what could be the next industrial revolution when it comes to technology actually materialize in terms of the data, not just hypothetical stuff, but real hardcore progresses on certain projects that have been evolving for a long time. I mean, Google released Bard for the first time after they've had this thing for 5 years, and then they finally decided to give it out to the market. So in my opinion, the one thing that is different between the Fed injecting all that liquidity, which is his basic argument for why the recession is not priced in, but it's this artificial run-up we've seen over the past 3 months because of the liquidity the Fed put in, is that the market sentiment and the narrative has fundamentally changed in regards to how we value the magnificent seven megatech names that matter. Now, why is this important? Because there has to be a catalyst for Amazon to grow. There has to be a catalyst for Google. There has to be a catalyst for Facebook, NVIDIA, Tesla. And The catalyst unilaterally decided by the market is 2 letters, AI. You can either agree with it or you can disagree with it. And I think there's a healthy dose of skepticism that should be there, but there's a lot of optimism that should also be baked into on this if you've done any sort of like research on what this could be. And I think Microsoft's, basic announcement last week kind of proves the point. For them to announce a $30 subscription to 400 million users, and the subscription value proposition is, hey, you already have Microsoft Office, add AI to Microsoft Office. The market's factoring in 10% of those 400 million users adopt it, and that adds $16 billion per year of top-line revenue to Microsoft, which allowed them to give Microsoft like $80 billion in market cap, which is a 5x multiple on that 16 billion. That is one use case of AI. And so whether he's right or wrong about, he's definitely right that the Fed injected liquidity and that stimulated the markets, but he's also not taking into account, and this is not the only reason the markets went up, but he's also not taking into account the sentiment around the market change. I mean, this is why we saw Palantir go up as well. Now, the other thing he's not taking into account is inflation. Inflation went from 8% to 3% in the past 5 months. And so that is another thing since March that's important to remember, because when that thing came down, then this was also really important as well. Let's finish up his thoughts here on what he expects for earnings this week.
I think it's all about the guidance, right? The earnings, I think, have come in better than expected so far. They almost always do, but it's really about the guidance. And I think you saw that with some of the tech names last week, where the numbers were good, but whether it was Netflix or Tesla, the guidance was a little squishy. And
we saw it with Ryanair this morning.
Right.
Too.
So it's always about the guidance, and it seems to me that that will tell the tale with a third of the S&P 500 reporting this week.
So what do you do right now?
My own opinion is you want to stay close to shore. You want to focus on a lot of quality. There's still an awful lot of companies. 40% of the Russell 2000 hasn't had a profit in the last year. So you want to focus, given the fact the cost of capital is rising and has risen meaningfully, and we have not seen the full impact of that increase in the cost of capital. It seems to me you want to focus on the quality companies, right? The shorter duration companies that have the ability to give money back to shareholders. Now, the thing is, that includes the Magnificent Seven, probably most among any company, right? Because they generate tons of cash. They don't necessarily have to put it back into CapEx or R&D. They could just wind up giving it to shareholders in the form of dividends or share repurchases. So you have to be very careful, because that's a big portion of the market.
So sorry, guys, I was muted. I agree with him there. This is a good comment by AJ. I'm not sure if the AI revenue multiples should be even across the board. It looks like they're giving it almost 20x multiples across the board for AI services. I agree. And that's where you get a company like C3 AI that is not profitable, that is slowing down revenue growth, and that is get up 300% for the year. And that's why it's so important that Palantir got profitable, and that any company you're in right now, especially if it's speculative, gets profitable. SoFi, hopefully, it's not going to be profitable this quarter, but most likely than not, by Q3, they will show a profit. And that really matters, because in this day and age, where the market is, where the cost of capital is, you've got to get a profit for the market to not be able to be like, okay, we're paying $1 for your shares, but this dollar isn't worth anything because you're not showing any net income. If you can at least show some profitability and show the fiscal discipline as a company to be able to maintain profits for shareholders, it at least gives you a little bit more of a leg up in this market that we're having right now. David B, $27.99 super chat. Thank you so much, David, for that. That means a lot to me. Do you think Google should break up into 4 separate companies? Google, YouTube, Google Cloud, Waymo. It would be very interesting, but I don't think that's going to happen. Google is not at the point where they can do anything dramatically like that. I think if you did give YouTube its own company, it could be a really nice big company and it could do really well. We're seeing the market tank a little bit right now, but in general, Google's not going to do that. Google's just not in the position where they can afford, in this market where the market basically thinks they might have an existential crisis because of ChatGPT and what's happening with search and advertising, to do something massive like break up their company. So it's an interesting thought project. I just don't think it would happen. Palantir down $16.30, so it fell about 1%. Nvidia's down a little bit at $442. Nasdaq is still up. Enphase is up. Financials are doing well. S&P down a little bit, but it's still up for the day. Rubicon Technologies, before people, I actually did a video on this, before people go crazy about the stock, yes, it's up like 300%, not 300, but like 140% in the past week. Please remember, Palantir did not buy shares of this company. They were given shares, if you look at their SEC filing, because Rubicon could not pay for services. So they bartered equity in order to pay for the alleged services, like probably from Foundry, that they got from Palantir. So before you go crazy about the stock and think, oh my God, it's like going up 100% and Palantir's involved, Palantir didn't buy the shares. Why is it up 100%? I have no clue. I don't know why people are buying the stock. I have zero. The company is not that interesting to me, to be honest. It's like a waste management recycling company. There's no reason for it to be up 100% outside of the fact that people are speculating on it. An insider bought like $100,000 worth of shares, which is nothing. So please be careful on RBT. I would really not speculate with this name. Palantir did not buy shares. They bought shares in Lilium. They tripled their position in Lilium. They actually bought the shares, even though they're down 80%. Rubicon, they were given the shares because Rubicon couldn't pay for services. So just please be wary of that one. Tesla now at $257, down 0.78%. Meta down a little bit before earnings. So we're seeing some declines there. SoFi is down $9.35. SoFi earnings on July 31st. I think they're going to have a good earnings. I don't know how the market's going to interpret it since it's up 60% for the month. If anything, hopefully SoFi stays flat or runs up a little bit. That would be nice, but I don't know where the market's going to interpret a company that has done well for themselves, but even in the past couple of months, they've run up significantly, so they might be due for a little bit of a pullback. Palantir now falling $16.25. We're seeing a little bit more red in the market, so still a little bit more of a downturn. Robinhood at $12.81. Coinbase under $100.97. And we got QQQ down today at $375. Companies with a lot of debt are going to suffer. Imnop says that. Yes, I agree. Now, again, companies with a lot of debt are going to suffer, but it's a question of, does the market think that they have the capacity to continue doing what they need to do in regards to a growth narrative that they put out? And so again, this is not 2022, right, where SoFi and Palantir are unprofitable and like their growth prospects are kind of like mushy. What was SoFi going to become? What was Palantir going to become? And so the market tore them down. 2023, the growth prospects are a lot more clear. Market sentiment has changed, and the companies are profitable, if not getting to profitability very quickly. And so that is the one difference between this market and last market. The macro thesis is whatever the macro thesis is, but the actual individual companies are finding a way as quickly as possible to get to GAAP profitability and to basically show the market, look, we're not playing around. We have a growth trajectory here, but we are also fiscally responsible. It's not like DraftKings, which I believe is not profitable yet. And it's kind of just saying, oh, the sports betting market is going to be huge, so bet on us, but we don't make a profit. It's an interesting company, but in this day and age, the market, and this is a lot of Cappy stocks, are just not going to be rewarded. ARK, I'm assuming down, $47.13 today, as it is down. Amit, can you give a brief explanation of what happens to your stocks in a buyout situation from both companies? Usually the company that buys the stock, share price declines because they're spending money to be able to buy a company. And the company that is getting acquired, the shares run up like either, 5 cents or 10 cents away from the purchase price. So if company X is purchasing company B for $95 a share and company B is at $50, it'll be at like $94.30 for like that entire day. And then your shares get liquidated and you get the shares, or you can sell it like right below the acquisition price. That's basically what usually happens in that situation. And then it keeps going from there. Companies with short duration will suffer. Those with foresight to have long dated balloons should be fine because of oncoming rate cuts. Well, that's the thing. And this is where I spent a lot of time this morning reading. I went out, took out a walk. I was listening to a bunch of people. I don't know if we're definitely getting these rate cuts anytime soon. I want to say we are. I think it makes sense for us to get it. It doesn't make sense for us to not get rate cuts anytime soon. But I have zero clue if it's actually going to happen anytime soon. I mean, one could argue it's not happening, immediately. That's for sure. And so 2024 is what we got to see. But then you get other people. So I'm going to play a clip right here. Then you get some more people that are, this is also where people think actually the rate cuts are more likely than we think they are, and it's a little bit more risk on. And so you got to have a mix of like, do you want to be risk on or risk off right now, given where inflation data is telling us where to be?
Companies here that are benefiting from a lot of those same secular and cyclical dynamics. So small cap companies, small is beautiful.
So when you're talking small caps, I know your company, you have your own, you're talking your own book a little bit. You have your own ETF you want to talk about. Give us the ticker. And when you invest in this, what are you getting? And why would you invest in this today ahead of that Fed decision?
Well, what you're getting is, so we're talking about the Gabelli Small Cap Growth Fund. It's actually a mutual fund, one of our oldest. And it benefiting from a lot of these cyclical dynamics. We're talking about soft landing. If the economy is going to have a soft landing, many of these cyclical companies that have been beaten up recently are going to do better. And irrespective of what happens with inflation and rates, we're finding good companies run by good management at attractive valuations. We're finding a lot of those in the small cap area.
Okay, so you're finding that in the small cap, but are you finding value there as well? Because I mean, in all fairness, we look at some of the Magnificent Seven stocks, a lot of these mega cap tech stocks. They're also well-run companies with a lot of protection from recession and cost of capital. They're not as cost of capital sensitive, where small caps tend to be more cost of capital sensitive.
That's true, and I think the outperformance of the Magnificent Seven and some of the large cap stocks can be partly explained by the fact that they were viewed as safe havens, especially earlier part of this year as we went through the debt dynamics. That's created a huge gap, one of the biggest gaps in decades between large and small cap stocks. I think, as we all know, large has kind of trounced small for a long time. We think that's beginning to shift. It's actually begun to shift in July. The Russell 2000 is actually up almost 2 times what the S&P is in the month.
All right, so you're just referencing our summer stock spotlight series, what we did today, which is emerging markets. So you mentioned Mexico, the Mexico ETF outperforming the S&P so far this year, up about 26%. Is that someplace you would put money into today?
It is. We like some specific companies in Mexico, particularly Grupo Televisa.
Now, the main point of what he's saying there is that small caps are going to get a little bit more momentum here because money is kind of rotating from some of the bigger tech names into some of the smaller names, because some of those smaller names actually are not the safe haven that investors are looking for, because those big, large tech mega cap companies aren't that safe given how much they've run up. And so money is trying to find a home for them in different locations. The NASDAQ falling a bit right now at $14,003. We'll see if it goes below 13,000. S&P, is that down as well? What do we see on the S&P? S&P is barely up, kind of flat for the day, but not in the red yet. And so what I think is going to happen, quite honestly, could be a little bit of a rundown before we get into that Fed meeting. And the Fed is then going to say that one rate hike. Everyone's going to have expected it. And so we might rally just a little bit on that. And then as, J. Powell continues to get hawkish, then the market might actually continue to go down. This 450 level on the S&P is really important. If we break 450 on the S&P, it psychologically, it's one of those things where now we are not within 10% of 2022 highs. Remember, we are trading 20 times next year earnings on the S&P 500. And the only way to justify that is not only for big tech to perform the way they're doing, but for us to not have a recession, quite honestly. We cannot have a recession if we want to be able to continue to do the things that we're doing. If we have a recession, and when I mean a recession, I mean like not a horrible, 2008 Great Depression type thing, but a decent recession where we see some pain. It's just not possible for us to be able to justify where the S&P is right now, where a lot of valuations right now, if we have that. Because just think about like a company like Meta. Meta is expected to bring in $31 billion in revenue on Wednesday, right? How does Meta get that revenue? Because advertisers are willing to throw in so much money on customer acquisition because customers are actually willing to pay for those products. The only way that happens is if we don't have massive unemployment. And so the Fed has somehow been able to balance not having massive unemployment, but still having inflation come down and actually seeing wage growth. Somehow we've been able to have this type of economy, and then you add in the AI sentiment, and then boom, you've got a market rally. If we cannot continue strong labor markets with decreased inflation, the earnings for these companies are not going to be able to justify the valuations that they're at right now. There's no way, Meta's going to bring in $31 billion because the advertisers aren't willing to pay for that customer acquisition because customers aren't willing to buy. Now, in my opinion, I think that was the scenario when Meta was at $88. That's where the market was. Things have fundamentally changed from them. A company like Meta, I don't think is up because of AI. A company like Meta is up because it was trading at an 8 PE and it was growing. The free cash flow was out the wazoo, right? So that's why the 52-week low on Meta didn't make any sense. And so the narrative of we're going into a recession and companies won't be able to continue to purchase from other big tech companies like advertising, for example, I feel like that happened in 2021, end of it, and all of 2022, and really 4 or 5 months of 2023, and things have changed. The question is, have things changed for the permanent, or have things just been a little flash in the sky, and we're going to continue to see some downward momentum? End phase now at 176. Again, Rubicon, this is a company I would not speculate on. It's very, very risky right now. Palantir did not buy their shares. They were given to them because Rubicon couldn't pay for services. So, I mean, Rubicon is not one I would be super excited about right now. Enovix at $18.95. So Enovix is down. They have earnings on Thursday as well. Tesla at $2.57. Truist at $33.18. I listened to the Truist earnings call again. Again, Truist is in a fine position. They're just being a little bit more conservative right now with their balance sheet, and they're restructuring some parts of the business. They got some downgrade price targets at 37. Consensus is around 40. So I think Truist will be fine. For Truist to fall back to the lows of 26, 27, those would be 5-year lows, and they would require a 20% downturn in Truist, which is already down almost 38% for the year. So could it go lower? Yes. I just, given how the market already interpreted earnings, I'm not sure if there's a lot of downside momentum there. Now, there will be if big tech earnings takes a shit and then the S&P takes a shit. Everything is going to shit, but it's just a question of if we can get there. Robinhood now at $12.78. Palantir at $16.25. DNA is ripping. Yeah, this one's DNA is interesting, man. It's DNA is doing well. Well, it's down 4% for today, but it's up pretty nicely from the lows of 130. Yeah, I mean, look, I need to see their earnings numbers. I think after earnings, if numbers are good, it could possibly go up a little bit. Remember, DNA still is a $4 billion company, and they've got $1.3 billion in cash, which is really good. But I think the market needs to see a lot of execution for them. DNA as a long-term, I think is fine, but like really long-term, not like 4 or 5 years, more like 10, 15 years, just given where synthetic biology is going. ARC-G is probably the better bet if you want, some decent returns on genomic companies. But again, even them, their thesis has to play out, and their thesis might just take 10, 15 years to play out. Now, that's not the goal of their thesis because it's an actively managed ETF, but, we'll see where it happens for them. Enovix is on Wednesday, Enphase is on Thursday. Okay. Enovix is on Wednesday, Enphase is on Thursday. Would you agree SoFi should purchase Lemonade, bring insurance policies in-house and their UI, especially with SoFi taking with Invest so that it doesn't have to build themselves? I actually haven't looked at Lemonade stock in a while. What's the market cap of Lemonade? 1.15 billion. I mean, I don't think SoFi should buy Lemonade. I don't think they have the capital, nor do I want to be diluted as a shareholder because they're going to have to dilute the crap out of me in order to buy Lemonade. I think SoFi is doing, look, my expectations for SoFi are that they're going to beat on deposits. They're going to beat on Galileo growth. They're going to beat on member signups. And they're going to beat on revenue. And remember, EBITDA, they expected 45 million last quarter. They brought in 75 million of EBITDA. This is a company that actually really is executing all cylinders. And one thing that we keep forgetting to talk about is student loans are coming back in October. Those student loans should be adding $40 to $80 million of revenue every single quarter back to SoFi. And so the stocks run up a lot, right? The stock's at $9. It was at $4. So the stock has done phenomenally well, which is why I think even if they do good on earnings, it might be a little priced in. And if we at least stay flat, I wouldn't be sad about that because then we've hopefully consolidated at $9. If you're a SoFi shareholder, you are looking for consolidation at $9. That's it. If we're at $9 till the end of the year, I'm happy as a SoFi shareholder because we are consolidating. That means it's very difficult for us to go back to $7 and $6. And again, SoFi is more speculative. So if you can get some real market kind of sideways action that at $9 the market is willing to value this company, then you have more upside momentum and the downside is a little bit limited as SoFi becomes GAAP profitable. And same thing for Palantir. If Palantir stays at 16 for the rest of the year, I would be pretty happy because 16 is a pretty overstretched valuation on it given the growth. Now, if the growth is there, then by all means, I would love it to go up. But if we can consolidate at this level, so we don't have like a $35 level by the end of the year and it's up 300-400% and it's all crazy meme mania, then I actually wouldn't be sad about that. AMC, let's check on them. They were up 40% in the pre-markets. Yeah, they're up 16% on the day. Something went on with their ape coin or whatever that something happened, to be honest, where it's not part of the stock anymore. It's like less dilution or whatever happened. And so AMC went up. Now, the interesting about AMC is it is the number one stock that is held on Robinhood, which blew my mind to figure out. So all of the momentum on AMC, the volume is now, 18 million, which is crazy. That's actually not that bad for Robinhood because Robinhood's making sure all of those trades go through and collecting that payment for order flow, which is not bad. AMC calls up. Wow, you had AMC calls, Ren? Wow. You're up 200K on call options. Look, that's sold them though. Yeah, that makes sense. That makes sense. That's not bad. 200,000 on AMC. That's crazy, bro. I didn't even know people were still making money actively on AMC or trying to make money on AMC. Well, it's big on Robinhood, so that's great for Robinhood. A dovish Fed this early means something is breaking amid. It's a red flag, in my opinion. I don't think the Fed is being dovish at all. I think the Fed is going to not be dovish at all. I think this Wednesday, the Fed is going to raise rates, and they're going to say, hey, we're going to continue to raise rates, and we're going to all have to deal with the Fed raising rates. I don't think the dovishness has necessarily come yet from the Fed's perspective. And I don't think they want to be dovish. They want to continue to, have options to be bad. Twitter name change. So another big thing that has happened on Twitter, if I share my Twitter screen right now, you will see that the bird on Twitter has been replaced by an X logo. There you go. That's what you got on Twitter. Elon Musk has officially changed Twitter to X. The CEO of Twitter, Linda Yaccarino, basically said, this is Twitter headquarters. This is insane, right? There's your X. Basically said that the new X app is going to be a state of unlimited interactivity centered in audio, video, messaging, payments, banking, creating a global marketplace for ideas, goods, services, and opportunities powered by AI. X will connect us in all ways we're just beginning to imagine. Look, I like it. It's a little cheesy. It's a little kind of like, all right, whatever. But I like it because what Elon's doing is basically creating a brand new brand, getting out of the Twitter baggage and saying, look, X is going to be this product that transcends the way we think about media, about banking, about consumer transactions, about information, about real-time updates. And I actually like that. I think it's a fresh start for the company. And he wanted to name PayPal X.com back in 2000, and Peter Thiel didn't let him for whatever reason. So he finally gets his X.com. It is now Twitter. And so that's what's going to be happening right now. 2% not possible until the administration gets off the back of oil and gas companies. I think that's also true. I mean, let's go to oil futures right now. Oil futures, $77.95. Crude oil futures up 1.14%. In the past month, they're up 12%. Let me actually share my screen right here. And this is another thing. This is 23% of factoring in inflation. This is, someone says Xerox called. They want their logo back. Yeah, that's hilarious. This is what's also causing a little bit of more upside in reacceleration of inflation. Now, granted, this could decline as well. This doesn't have to be where it was. Remember, we were trading oil at like 120 about a year ago. So it's come down a lot since then. And even since January, I mean, gas prices were like $4, $4.40. Now it's at least at $3.20. So we're seeing it come down. Over the past 6 months, it's down 2%. Year to date, it's up just 1%. 1 year, it's down 20%. I mean, and this is the good thing, right? July 25th, 2022 was at 96. Now it's at 77. If we break 85 on oil and we're getting a little bit closer to those July 2022 levels, we got a problem. And so we need to get to a point where it's not, as bad as we see. As you see in 2020, it went down to $22. So if you bought oil futures in 2020, you've done really well. But I think the data is still too far out to know on this. But it's definitely, everything when it comes to inflation is something to monitor right now. Because if we see the reacceleration in inflation happen to the point where we're above 3% next month, getting back to 4%, things are not going to be in a good situation. The Fed's going to have to double down on the hawkishness. If we see it barely going up, or we're at 2.8, 2.9, or it's at least flat, we at least have a little bit more momentum to keep going down from there. If he's getting out of the Twitter brand, why did he pay $44 billion for the Twitter brand? You know what I think he bought? I think he bought the network effect on Twitter. Again, as someone who's trying to build my own startup, the hardest thing in the world to do is actually build the thing that is the center of all the attention. And even if you have to pay a premium for that, people don't understand what happened to Twitter. Twitter was growing at like 5 users a week in 2006, 2007. They had a lightning in the bottle moment where they went to South by Southwest, which is a conference for tech, culture, etc. back in 2007. They had a big LCD screen. And on that LCD screen, you had real-time updates of tweets. And people that were going past the LCD screen, they were like, oh, what's this? And so they were so intrigued, they just downloaded the app and they started tweeting. That day, they added like 60,000 users. And since that day, the company has skyrocketed in terms of user growth, now having almost 450 million users. I bring that up to say that lightning in the bottle moment in 2006 or 2007 that happened at a small conference in Austin, Texas, is the thing that builds multi-billion-dollar companies. And it comes once in a lifetime, right? It is one of the most difficult things in the world to be able to create. Facebook had its moment with Harvard. People forget Zuckerberg had a list of 100,000 emails at Facebook. That's why he was able to get those users. He didn't get those users just because they came out of nowhere. He had the emails. He was able to get them onto the website and then started building from there. I think the 44 billion relatively is cheap long term if Twitter can become what it becomes, because creating that network effect is impossible. This is why Mr. Beast, they ask him, hey, do you want to just create another YouTube? You have all these subscribers, bring them to your new platform. He's like, no, because YouTube is YouTube. YouTube has 2 billion people. Why would I want to make something new and try to do what YouTube has done when YouTube has done something so well? So I think he paid 44 billion, which he obviously overpaid in terms of realistic terms, but long term, I think Twitter is the biggest real-time communication network on the planet, and he bought it and now he owns it and now he can do whatever he wants with it. So I think it's not too bad. He did say the most likely outcome is the most ironic. Elon is a supervillain. That's correct. Silly, he sued to get out of it. Well, yeah, I mean, he definitely wanted to get out of the deal. I agree. It's not like he wanted to pay 44 billion, but you know, he ended up having, well, again, I agree. When the market turned down, he wanted to get out of the deal. But remember, he offered 54.20, which at April 2022 was a fair valuation for Twitter at 44 billion, because Twitter was trading at like $45 or whatever. So he offered a 10% premium on Twitter because market conditions changed. Now, obviously, interest rates have rose dramatically since then. I think if interest rates were at 2-3% like it was back then yeah, 44 billion doesn't sound crazy. It sounds crazy to us now because of where interest rates are. Do I think it was paying a lot for Twitter? 100%. Long term, do I think buying the biggest real-time communication social network on the planet is a good move because I trust Elon will be able to transform it? Yes. It's just a question of if he's able to do it now. All right, that's it for me. Thank you, everybody, for being here. So the things to monitor right now are inflation, where things are headed right now. The Fed is likely going to raise 25 basis points. I will be streaming a bunch of earnings this week. I'll be doing Enphase, Meta, Google, Microsoft, most likely. I think Amazon we have this week. So we have a lot of earnings this week. Big tech's got to do what they need to do. The Fed's likely going to raise 25 basis points. I'll probably stream the FOMC meeting on Wednesday, and then we will keep going from there. Amit, why do Carlos and Vitaly have a strong dislike for Palantir? I don't know. It's like I've been trying to tell these guys for like months now. Why? I don't know why they don't like being up 150% in 2 months. I don't know what their issue is. No, I mean, their issue with Palantir, quite frankly, is they don't understand the long-term trajectory of it, and they're more excited about things that they can understand. Like Enphase is something they can understand. They can see solar penetration. Again, for Palantir to understand this company, you've really got to be in the weeds of it, and most people don't want to do that, which is why hopefully some of my content provides some value to other people. But all right, that's it. Thank you, everybody. Got a couple more videos coming out a little bit later today, and we'll see you guys tonight on Finance Junkies, 7 p.m. tonight. We're live 7 p.m. for Finance Junkies. Have a great day, everyone. See you later.